you have defined the parameters that matter, within your framework and within DSP's framework, how do you decide whether to buy a particular paper or not? How big a concern ratings are for you? How do you, make sure that credit worthiness is maintained? And when do you sell? And also, if you can give us some difficult examples you've had to tackle, that'd be an extra bonus insight for us.
Hard. Now, Ankita, I've quietly used the word good companies a couple of times, and that was my hints that I was dropping in. So what is credit basically? I mean, I would broadly say if we can't print money and pay back your debt, that is credit. And credit rating itself is a measure of credit worthiness, which you can say has two components: the ability of the borrower and the willingness of the borrower. The ability is a sense of business and financial risk. I mean, I'll just put it simply. Let's say you take a commodity company and commodity prices go up and down. Obviously, the company makes a lot less cash flows when the commodity prices are down. So that has one impact. And let's say it's putting up a large capex when the commodity prices come down. The impact on credit risk will get magnified, right? Because the level of debt, it's a level of cash flows in relation to debt, and that deteriorates. So the ability comes down and you'll have ratings going up and down. That's just one part of it. I think where at DSP we are putting in a lot of effort is in what we can broadly say is the willingness part. And for that, I have to use the big G, governance, right? It's the market's perception of the governance practices of a company that actually leads to whether this company would likely default or not. And that is a very important part of where we put in a lot of effort, reference checks and everything else. And once we assign a certain limit on a company after doing all the due diligence, we are on our toes constantly. So we look at various impulses that are there in the market, equity prices, whether the stock prices moved up and down, bond spreads, bid offer quotes, media articles, whether there are any sudden board or management changes which can be potential red flags. So we track that very, very diligently. Now, frankly, as a credit analyst, I would say that I'm not so fussed about a one-notch downgrade here or there because of cyclical reasons, right? I mean, at the end of the day, a good company will take some amount of risk. But what I would like not to see is governance-related risk. And in the post-ILFS era, for example, there has been now an obsession with the AAA rating. My portfolio should be more AAA oriented. And that's what we request investors to go beyond. Because rating is also another opinion only, and it can go up and down. But has the fund invested in good companies of good governance that you can recognize? Once you do that, you're almost home.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.